So you just arrived in the UK and that relocation bonus just hit your account. What's the smart thing to do with this money? So today we're getting two AI platforms. I'll be running this exercise with Google's Gemini. What is this? I said give me a table, you gave me this rubbish. So equity is 60%. You're a joker. I want to try out this same experiment with DeepSeek and see if DeepSeek gives me better answers or gets to the point faster. Okay, how would you make this plan more action? No, don't let me ask it how it would. Make this plan more actionable by suggesting platforms considering fees and ease of use. I wanted to give me suggestions on the ISA because it didn't even consider LISA or JISA. LISA, junior ISA don't make sense for a 6-year time frame. And I love the fact that DeepSeek is just not even considering things that do not make sense for a 6-year time frame. Because if you do a LISA, you can only withdraw that money to buy property. So if you're only here for 6 years, what property do you want to buy and sell in 6 years? It's not a great idea unless you will keep the property. So these are some of the things people need to think about. That's why I always say I'm not a financial advisor, because a financial advisor will sit you down and you will go through your own personal plan together. They will ask you all these questions, you will check it, you will consider it, you will book subsequent meetings. They'll do projections for you. They'll project, okay, if you continue like this is what your money will look like in the next 20 years. If you have plans, you want to buy property, you want to have kids, this is how it will interrupt at your whole assets. What exactly do you want? So the way you invest your money depends on what you individually want for your long-term future, even if that money is going to be short-term investment, medium-term or long-term investment. So those are the kind of things that a financial advisor, see, I'm hyping up financial advisors today because it's not an easy job, because it's almost like a therapist. Most of us, we can't think through our thoughts by ourselves. We don't need someone else. But really, by the time you have a session with a therapist, you'll find out that it's actually helpful because they ask you things that you know already. They're not telling you anything. Most of the time, they just ask you questions.
How does that make you feel?
And you answer the questions. But the exercise of going through that Q&A with yourself helps you to crystallize your objectives and what you really want. And then you can act based off that. So we can say financial advisors are the therapists of the financial world. Oh, I love this guy. This is such a fantastic exercise. So let's look through these answers. Set up your emergency fund. That'll be the first thing you do. Cheap instant access account gives you 4.8%. Monzo, if I go to Monzo, I'll go to Trading 212. Cheap is a good one. It's a good option. I see it all the time. It's just like, I don't want to open another savings account. I've almost opened a savings account. Like almost every year, I'm opening a new savings account because of rates for my emergency fund. Vanguard, Interactive Investor, Hargreaves Lansdowne. Why are you giving me these as the options? So now it's saying 70%, 25% bonds, and 5% cash. That's not how I like to do my allocation. Yeah, so if your employer offers a share incentive scheme, you need to check. If they do, it's also a good opportunity to invest. It's just that it increases the risk because you work in the same place that you're investing in. So if something happens to the company, your investments, your company, your job at risk. But still, if it's a good company and they offer a share incentive plan, it's a good way to invest. You might just want to watch how much you put into it and not max out. Yes, avoid overexposure. See, DeepSeek is the bomb. I'm going to critique my own personal account with DeepSeek later. This is something that is good. Rebalance every 12 months, sell overweight access. So what it means by rebalancing is, let's say I have 50% of my allocation on the global ETF. I'm just picking arbitrary numbers. Let's use 50-50 to make it easy. So let's say I put 50% in a global index and 50% in NASDAQ 100. And as the year goes on, typically NASDAQ will outpace the global index. So you end up with 45% global and 55% NASDAQ. You rebalance it by selling off that 5% so that it goes back to 50-50. The reason you do that is because when NASDAQ does crash, as it has done in the last couple of weeks and everybody is panicking, you want to reduce, because if you had held on to that 55, that's 55% of a portfolio that crashes. So you want to reduce that your exposure to the exposure you were comfortable with when you started your investment. That way you're not tempted to keep tweaking it when there's a market crash. So that's the whole idea. That's how I reason through it. Currency hedging. This guy is telling me to use Revolut to send money home. Hey, correct. Use Wise or Revolut. Did you even mention our Lenfa? Correct. DeepSeek knows what's up. See, I'm impressed because I don't expect much from AI chatbots, but DeepSeek knows what's up. Stay disciplined, stick to your allocation, avoid chasing crypto or AIS hype. Yeah, fees matter. Vanguard is not the cheapest. How about trading? Do you even consider them? Or InvestEngine? How will they compare with platforms listed above? Let me say, how would you rank them compared to the platforms listed above? So rank everybody, think it through. Zero commission. It's going to be one heck of a video, but I'm loving it. Maybe I'll make it into a 3-part series. See, Trading 212 is number 1, InvestEngine is number 2. Action steps, fund with 20k, VWRL 70%. So Trading 212 is like your best option, but alternative, InvestEngine, managed? No, I wouldn't do. They okay, sure, if you want them to manage. It's just that they charge you. How much do they charge you for managed? So Vanguard is more expensive. I think it's capped, no? So these are the drawbacks. Limited funds, no. It gives you all the regular funds that you need. I don't know what they mean by limited. Trading 212 doesn't. The only drawback that Trading 212 has is the interface is not as simple. It's not as intuitive as InvestEngine. That's the first platform I started using in this country. I've been using it since I got here, and I still struggle to find things. How to share my portfolio, how to check my cash. Sometimes you'll be clicking around.
What is this? What is this?
And they change it too frequently. They change it every year or so. So you can't even get used to the platform. That's the only issue I have with it. It's messy to navigate. But in terms of the usual things I actually look out for, use your money safe, are their fees low, the availability of funds and the availability of stocks. Trading 212 has everything. That's why I tend to default to InvestEngine, because InvestEngine is so sweet to use. It's so easy to navigate. Like, it's so intuitive. Trading 212 looks like they're still stuck in the heydays of stock trading. Everything looks like chat here, this, that. It just looks very. I like the platform, but I just don't like the interface. The SIPs are irrelevant for me. CFD, I'm not interested in CFD. How about, let me be giving it options. How does it compare with the above platforms? I still need to get into that breakdown. Spreads, high hidden cost. So zero commission is misleading because it profits from spreads. Okay. Oh, so my own reason of not liking it over the other time, I said I don't like it because they encourage people to trade. So spreads that is talking about here basically means that you say you want to buy at a particular price. They'll tell you, they'll place your order, but they now place the order, but they implement it in such a way that by the time the order goes through, they are able to buy at a price lower, and that difference is the profit that they keep. So this is speculative because I don't know where he's getting this information from. Okay. So eToro is not the ideal one. I'm not going to use my SI allocation for crypto, but I use eToro to buy crypto. That's all I use it for. I don't like copy trading. Copy trading is not even something I encourage. If you want to invest. Like my dad would say, you can't use someone else's clock to run. You can't measure your investments with someone else's objectives. You don't know what their objectives are. You assume everybody's objective is to grow, yes, but in what time frame? So if my plan is, oh, I need to protect this money for the next 1 year because I need that cash next year, and this person's plan is, oh, I'm going to grow this money for over the next 10 years. Our plans don't align. I can't copy their portfolio and then next year I now need the money and the market has dipped. So let's discuss the ETF funds within the allocation. How would you compare your suggestion with the following allocation? Now I'm going to give it my own allocation that I like. 50% VV, 10%, no, let's say 12% VFM. I've done this somewhere else, that's why I know the numbers. VV is developed world. VFM is emerging markets, that's your China, Brazil, India, and the likes. Another 12% in S&P 500 because it's the States. 12% in FTSE. 200 is ISF. So this is 12. Let's add something from X trackers. XDQ. So that's 12 times 4. There's a 4% missing. NASDAQ. So 48% VV plus 12% VFM is global. That's the world. because the global stock market is basically 90% VV and 10% VFM. So if I divide that by 2, I'm doing 50%, 45%, and I want to get 60% global, right? So I'm doing 45, it will be 45 and 5. But if I want to jump it up a bit, it will be 54%, and this will be 6. So this would be about 60% global.
Power off, Einstein.
Now, because I believe that China is gonna get strong, this is me now speculating. Please do not do this at home. But let's see. So let's say I take out this, because again, XDEQ is basically the same as VV. So that's 70%. Okay, so now how do I split the remaining 30%? S&P 500, UK, and NASDAQ. ITU is tech companies within the S&P 500, which are actually having a downturn at the moment. So you can get very good companies for cheap. Cool. So this should be 30, because I have faith in Amazon. So instead of just doing my pure tech, I keep it at NASDAQ instead of doing ITU. Your proposed portfolio is growth optimized, but it carries significant risk. Yes, I know. It carries significant risk for a 6-year horizon. I don't want bonds. I don't get the thinking behind defensive assets. Unless you're planning to retire soon. It makes sense though, because it's looking at 6-year horizon. So this is good. Ongoing fee is 0.1 to 0.3 because of the EQQ. The EQQ is NASDAQ. That's why I replaced it with IITU, which is S&P 500 tech stocks. Because like 80% of NASDAQ is tech anyway. This is actually a very good analysis because it's saying the portfolio that I recommended is growth heavy, which makes sense because I am not planning to leave the UK in 6 years. So my portfolio is growth heavy because I'm like, see, whenever this thing matures, it matures. Because even if I leave the UK, let's say I travel briefly, I won't liquidate all my assets the minute I leave. You liquidate your assets when you need the money. You are not going to carry that money in a basket on your head and go back to your village. So I invest long term all the time. It doesn't matter whether I'm in the country, outside the country, that money is going to be there. So it's saying this because it's thinking 6 years. What if the individual does not want any bonds, or the individual wants 100% equity as they do not intend to liquidate the investment after relocating? For real, we've done 1 hour with DeepSeek. Stay the course, avoid tinkering. Avoid tinkering. Do not tinker when it comes to your portfolio. Don't tinker, don't touch it. Leave it. There was a podcast I was listening to. I'll link the channel down below. It's a Canadian investor, but his principles apply. And he was saying he knows he's doing something right when he forgets the password to his investment account, because he knows that means he's not checking it regularly, he's not tinkering with it. That's really how it should be. You shouldn't be tinkering with your investment portfolio regularly. It should be like once a year or once unless it's money that you're going to need in a year, which in that case should not be in stocks. Right? Do not tinker. It's a very good rule. Top up annually, yes. So what does the portfolio look like? 50% VWRL, quality, emerging markets 15%, okay, NASDAQ 100, and so nothing for UK, dividend aristocrats. Rather than do dividend aristocrats in US, I'll do UK FTSE 100, because UK FTSE 100 actually gives me better dividends than US dividend aristocrats. 40% VWRL. I don't want VWRL. I want to combine VEV with VFM. But this is a decent, simple, this kind of portfolio I like. The reverse allocation eliminates overlaps. Yes, VEV plus user, and simplifies global exposure with VWRL, which is why typically I tell most people just go with VWRL. VWRL is an ETF that invests in the top 3,000 companies in the world. We weight them depending on the size of the companies. So within that mix, you would have a 90% VEV plus a 10% VFM. But it's just saying avoid all that complication and go with one, which makes sense for a simple portfolio. It's saying added quality factor, yes. And theirs is stronger because they added both quality and dividends. I can get my dividends from UK equities. But it's saying my currency risk is high because of UK equity. I don't understand that. I agree, 6 ETFs are more complex. I really would love to reduce it even further. It used to be 7. But again, that was me tinkering. That was me not taking my own advice. So this is us getting into the weeds here. I think we have what we need. What's pitfalls? Common financial and investment pitfalls. Would you advise me against? Pitfalls that are relevant to newcomers, not just general pitfalls. This is the last question we're asking DeepSeek for now. I think I found my new favorite toy. Let's see what it's going to advise against. Skipping the emergency fund. So this is me. This guy is speaking to me. Because when I first of all started investing, I didn't do any emergency funds. I started investing straight, put all my money. I wanted to chop that 20k ISA and I didn't have enough money. So I put all my money inside ISA. No emergency fund anywhere. I was lucky. I was fortunate. I didn't really have any major emergencies except for one. When it was time for me to do my tax self-assessment, I was hit by a tax bill for the previous year that I wasn't expecting. I think it was like £3,000. It was a lot. So I had to raise that money. So that was one emergency that came up that having an emergency fund would have helped me. The second one, let's see, second pitfall, overpaying fees. Everybody comes and they're like, what's the most popular investment platform? Agri's Lansdowne. Let me go and put my money in Agri's Lansdowne. Did you notice that DeepSeek did not mention Agri's? Because I gave that criteria, low fees. Their fees are not low. You pay for that brand name. Number one, skipping the emergency fund, pitfall, investing all the 50k without reserving 3 to 6 months of living expenses first. Because if you have an emergency, you will be forced to liquidate and you might be liquidating at the wrong time. That's the reason for having the emergency fund separate from your investment, because you don't want to liquidate when the market is down, for instance. Then overpaying fees, choosing expensive platforms that erode returns, right? Because a 1% annual fee on 50k over 20 years is 12k in lost returns. I don't know what it is over 6 years. To prioritize ETFs with low, because each ETF also has its own expense, TER, that's the expense ratio of the ETF itself. So I also look out for that. PWR is cheap enough, it's 0.2. 0.2 is a good range. 0.3 is expensive. I've seen ETFs, I think they're like 0.6. That's high. Because 0.6 is eating into your returns. Home bias, overloading UK assets. So while investing in UK stocks, this is good because you're familiar with FTSE 100, you know the companies in there. The risk is that the UK is just 4% of the global markets, right? So if you put all your eggs in that small 4%, how much growth can you get? So he's suggesting you keep it on that 10%. Yeah, I can do 5% because it gave 5% to my dividends. Because UK stocks for me, FTSE 100 are my dividends aristocrats. The stocks that actually pay when it comes to dividends. Although not all 100 of them. What I typically do is I go within that list of 100. I look through that list and pick companies that their financials are healthy and they pay high dividend rates. That's how I usually come up with my own list of dividend paying stocks that I now invest in with trading 212 instead of doing the ETF. Focus on global trackers, that's important. Chasing past performance, buying hot stocks. All the people that are chasing Nvidia when Nvidia has already peaked, or people that are chasing Tesla when Tesla already peaked. So you don't buy brand names. That's one of the first lessons I learned when I started investing back home. Don't buy brand names, don't buy adverts. You buy shares. So the fact that a company has fantastic adverts, their performance may be horrible. The fact that a company has a great brand.
But we're not just talking about a product here.
In some cases, they have a great product as well, but the company performance might be bad. There are lots of companies with great products that end up crashing out or being dissolved over time as someone else buys up that company at not a great rate. So that's not enough. The company product is not enough for you to know its performance or anything. My own approach is to check their books. And of course, checking their books involves checking their past performance, which again is not a predictor of future performance. But compared to checking just their brand name or speculating of their products, if I'm going to speculate of the products, I'll go and do it with an EIS investments, an enterprise investment scheme, where at least government will give me small rebate on my investment. So if it doesn't work out, it doesn't work out. Stick to a diversified rules-based portfolio, meaning this and that, okay. Ignoring tax efficiency, this is using a taxable account instead of maxing out on your ISA allowance. This is a very big one because a lot of people, I almost made this mistake too if I didn't learn about ISAs. I'd actually opened a trading 212 account because I was chasing the cheapest fee-free platform, but I didn't know anything about ISAs at the time. So it was when I spoke with a particular financial advisor that the guy mentioned, oh, this is how much taxes you pay on capital gains, this is how much taxes you pay on dividends, this is how much taxes, but if you want to ignore all those taxes, just open an ISA account. I was like, why didn't I hear about this before? More, I jumped on it. Emotional investing, yeah, panic selling during crashes. Do not do this. The market is going down now. People are like, oh, what do we do now? S&P 500 is falling. Buy it. That's what you do. You buy it.
Buy.
You don't sell when everybody is selling. It's counterintuitive. Think about it this way. If everybody has a product, everybody has bags, and we're all selling bags. If all of us are selling bags, this is economics 101, your price of bags will fall, right? Meaning each one of us will make less on each bag that we sell. But if everybody else is selling bag and me, I now say, I have my bag, Rather than make less, let me buy their bags. So I buy all their bags. Now I have all the bags and I bought them at cheap prices. When people need bags tomorrow, because people will always need bags, when people need bags tomorrow, who will they come to? They'll come to me. I can now raise my price and sell it at a higher price. All the other people that were selling yesterday will not be coming to me to buy at a higher price. Who has made money? Me. It's a silly analogy, but it explains the whole principle of never letting a good crisis go to waste. The crisis now is S&P 500 prices falling because everybody is selling. Don't let it go to waste. It's an opportunity. Buy. Again, not investment advice. I'm just telling you what I would do and my thinking behind it. We're complicating the portfolio, holding 10 niche ETFs, thematic funds. Yeah, keep your portfolio simple. Honestly, I am so guilty of this. That's why I have up to 6 funds in my portfolio. Ideally, I shouldn't have more than 2 or 3. Right? They say 3 to 5. 3 to 5 is good. You have a core one. Ideally, I should not have more than VEV for developed markets, VFM for the emerging markets, one for the tech industry that has been leading growth for the past 30 years, and one for UK dividend so that I can make some money from there. I shouldn't have more than 4, but as you can see, I have 6 because instead of put all my eggs in VEV, I want to have an ETF that nudges towards quality companies. So XDEQ is basically VEV, but now picking stocks within the VEV to identify the good ones within the VEV. So it's like stock picking without stock picking. When I look at the past performance, the performance is typically along VEV, sometimes slightly up, sometimes slightly low, but I just like to play with it. It's unnecessary. It's very unnecessary. S&P 500, having S&P 500 when I already have VEV is also unnecessary. It's just that because typically S&P 500 has outpaced the rest of the world. The US has outpaced the rest of the world in the last 10 years. That's why I bought S&P 500. Make your own decision. Currency risk. This one I don't understand. Allocate 10% currency hedge ETFs. I'm not doing. Underestimating inflation. Yes. Holding too much cash. This is a very good point. Keep only your emergency funds in cash. So you see, keep only your emergency funds in cash. So why are you allocating cash inside my ISA? This thing annoys me. Falling for scams. FCA registered platforms. Yep. This is very important. Use FCA registered platforms. That's why I always say when choosing a platform, the first thing you check for is are they FCA registered. That's the first thing before you even start talking about fees. Check are they FCA registered, then you check what their fees are, then you check the investment options that are available on that platform. So we haven't talked about junior ISAs or LISAs today. I don't know about the other platforms, but neither Trading 212, nor Free Trade, nor InvestEngine does LISA or junior ISAs. If you actually wanted to allocate some of your funds to that, you would need to get a different platform. So those are the things. But before you get to that, you need to check, is it FCA registered? What are the fees? Then you now look at, oh, I want to do LISA, I want to do action plan. Build your emergency fund, max out your ISA, automate contributions and rebalance annually. Stay globally diversified and educate yourself. The simple path to wealth. JL Collins and Smarter. See, DeepSeek is the bomb, man. I can't even debate anymore. DeepSeek is alright. We may not agree on my portfolio mix, but it's okay. We'll come back to this some other time. So I hope you enjoyed watching that, because it was fun. As you might have noticed, I enjoy poking AI chatbots and seeing how intelligent they really can be. DeepSeek really impressed me. Gemini got there eventually. Maybe next time we'll try Grok. If you guys enjoyed this kind of video, maybe next time we'll try Grok. And Grok is the Twitter AI, by the way. It's another AI that I actually like the way it performs. So maybe next time we'll try Grok and maybe Copilot. There are lots of them. There's Grok, there's Copilot, there's ChatGPT, there's Perplexity. If you go back to my video where I talked about if it's too late to start investing, if you relocated maybe in your 40s or thereabouts, I talked about using the available technology. And this is me doing just that. Use the available technology. You're in the West, there are a lot of opportunities that are open to you today that were not available back home. Make use of those opportunities. Make use of the technology available. Make use of the investment platforms, the investment opportunities available. Before I moved here, all my stocks were in Nigerian stock markets. Today, I can invest globally to take advantage of all these opportunities. But what's the real takeout of this video? You've seen my investment plan. What I want you to do is go through that exercise yourself. If you want, you can actually use an AI chatbot to do it with you. and give it the answers to those questions. You can ask it to ask you the questions, or you can just go with the questions that we already discussed and give it as part of the prompt and say, look, imagine someone in this scenario with this plan, this is their timeline, this is how much you want to invest. What would you recommend? You've seen DeepSeek did a great job. You could try Gemini, you could try Grok. Try it out, let it give you an investment plan, but then question that plan. You see how I kept questioning it, because the good thing about it is it gives you things to think about. So you came to this video to learn how to invest 50K. If I were investing 50K, this is how I would invest it. It will be first my emergency fund, just like it suggested. Then I'll max out my ISA, just like it suggested. Actually, the DeepSeek suggestion is it. First, I would put 6 months of my monthly expenses, not necessarily your salary, your expenses, because probably your salary, part of that is some other things that are not expenses. Maybe Netflix is in there, some other things that probably you won't be required to pay for if you didn't have a job. Monthly expenses, 6 months worth of the core expenses, I will put that in an emergency fund. So let's assume arbitrary number, let's say 15K out of the 50K. And then I will max out my ISA. Take advantage of that tax-free bucket. So 20K goes into that. So that's 35K. If I had a partner, I would max out their own ISA as well. That means we have 40K within 2 ISA buckets, right? And then we have emergency funds for the rest. Now within the ISA, you've seen the ETFs that is suggested. I would go on InvestEngine. At least half of my portfolio is always in a global ETF. If it's not BV, it's VWRL or VWRP, at least half. If you agree with it, you could go higher. Again, not investment advice, please. And then you can now play with the remaining amount and decide, oh, this is a good opportunity to buy US stocks because they're down now, or this is a good opportunity to buy tech stocks because they're down now. Always buy ETFs. I wouldn't put all my eggs in one company and say, oh, this company is going to do well because XYZ. What if it doesn't? Some ETFs do tank though, to be fair. I bought some ETFs when I just got here and they tanked and they still haven't come back up. That's why for this government gilt, I bought one ETF for gilt and just tanked and it hasn't recovered in the past 5 years. So ETFs do tank, but keep it global, keep it market based or sector based and you'll be fine. But that's within the ETF. So if I had 50K and I had 15K in an emergency fund, 20K in my ISA, if I had a partner, the remaining 15K will go into their own ISA if they haven't used their own ISA allowance. However, if I didn't have a partner,
My beautiful wife.
and I had 15K left, 10K out of that will go into a general investment account. Then I would probably split it the same way I split the 20K in the ISA, or depending on what I've done with the ISA, because I could do a ISA within the ISA. So if I come back to that 15K and I had 10K for a general investment account, which I split the way I just discussed now, the remaining 5K, I will play with it. So there's something I always say, whenever you have funds, you need to buy something that will make you happy. So the first time I did this exercise with Gemini, it was suggesting that I should invest in myself. I'll probably use some of that money to invest in a course or buy equipment for my YouTube channel or whatever makes me happy. It could be vacation, largesse, party, but that 5K I'll take out of it for that. Then whatever is remaining is going to be either a cross between Ethereum, which is the only crypto that I am comfortable buying more of, or I go on Crowdcube and look for some random company that I think has some potential and I throw in £500 or so on that company and we see where that lands us in another 10 years. So that's how I would spend 50K that I am not using on an investment in the UK. I didn't mention anything about Nigeria. Normally, if this was my first year in the country, I would have taken some of that money, converted it into Naira and bought shares in the Nigerian stock market. Why? Because I do believe in the growth in the Nigerian stock market. That opportunity is there. So if I were in the shoes that I was in 10 years ago, I would convert some of this money outside the emergency funds and ISA and buy that. I prioritize those two, and that's how I typically prioritize my money here. 1, emergency; 2, tax efficiency; and then 3, growth opportunities. Those are the 3 guidelines that I use to decide how I invest. Is either 1, general protection using an emergency fund; 2, tax protection using an ISA; or 3, growth opportunities. So that's typically how I would allocate a £50,000 windfall. So thanks for watching this video. If you watched up to this stage, you definitely enjoyed what you were watching. So why don't you just subscribe to the channel if you want to see more of this? Leave a comment below if you do want to see more videos like this where I interact with an AI bot, or I interact with something else as opposed to me just word vomiting to you guys on camera. And then let me know any other questions you'd like me to answer in subsequent videos. Let's look at the questions for this week. And we have a question here from @KOBW4GZ. What do you think about what is happening to S&P 500? The price is falling. Price is falling. That's a good thing if I want to invest. And I'm a long-term investor, meaning I'm not planning to liquidate my assets anytime soon. So if the price of ETFs that I'm buying starts to drop now, knowing that it comes down only to go up later in future, because the way the stock market works is prices go up, down, up, down, up. But when you're tracking the market and not just an individual stock, that's not a problem for you. If you're tracking individual stocks, so let's say you put all your money on Nvidia or I don't know, some other company that you're in the S&P 500 and everything now tanks, then you have a problem. But if you're tracking an ETF that is tracking a market, or better still, that is tracking the global market, like we talked about, VWRL for instance, that tracks the top 3,000 stocks in the world, all of them won't come down at the same time unless there's a global recession. So that's why it's good to be globally diversified. And even if you were just tracking S&P 500, which is top 500 stocks in the US market, unless you do not expect the US market to ever recover, then you don't have a problem. Because if the prices drop now and you buy when the prices are low, when the market eventually recovers, you would have made a profit. So no, I'm not worried that S&P 500 is dropping now. My response in the video was actually a quote from Warren Buffett, where he said, "Be fearful when others are greedy and be greedy when others are fearful." It's not the first time prices have fallen in the last 5 years. And I believe it was the former Prime Minister of the UK, Winston Churchill, that was quoted to have said that never let a good crisis go to waste. This is a crisis, right? Things are not great, but it's also an opportunity if you have loose cash. So for our hypothetical investor with £50,000 that he wants to invest, he may want to look at S&P 500. Don't mind me. Please do your own research, talk to an investment advisor. Now, in case you were wondering, this video was not sponsored by Google, not Gemini, not Google, not YouTube. It's sponsored by me. Do me a favor, click the like button below, subscribe if you want to, and don't forget, we don't just want to keep the gist flowing, we need to get our money growing. And then watch this video, this one here, that is right there. Watch it.